Where does money come from? Most people imagine a giant secret printer in a basement going brrr all day. But money is stranger than that. Some money is printed as paper bills and coins. Some money exists only as numbers on a bank screen. And some money appears when banks give loans. Wait, banks can help create money? That sounds like a magic trick, but it is actually how the modern money system works. Today, we will follow one confused stickman into the world of banks, loans, interest, central banks, and inflation. By the end, money will look less like mysterious paper and more like a giant system of trust. Before we talk about banks, we need to understand money. Money is not powerful because paper is magical. A bill is just paper. A coin is just metal. A number in an app is just a number. Money works because people trust it. If everyone agrees that a green bill can buy bread, shoes, or a banana, then that bill becomes useful. Long ago, people traded things directly. Fish for bread, apples for shoes, a goat for maybe too many apples. But trading was messy. Money made trade easier because it became a common tool everyone could accept. So money is basically a trusted promise that helps people exchange things without carrying goats everywhere. Now, let's talk about the money people can touch. Paper bills and coins are created by official money systems, usually connected to the government, the treasury, the mint, and the central bank. A normal bank does not just print cash in the back room whenever it feels bored. That would be a disaster. Physical money must be controlled, designed, produced, protected from counterfeiting, and released into the economy carefully. But here is the funny part. Most money today is not physical cash. It is digital money in bank accounts. So even though the money printer is real, it is not the whole story. The bigger story is happening inside banks, computers, loans, and trust. Now, imagine the main stickman puts $100 into a bank. He thinks the bank locks his exact money in a tiny bed inside a vault and whispers, "Sleep well, little Bill." But banks do not work like that. A deposit becomes a number in your account. The bank promises that you can use or withdraw your money, but the bank can also use part of the money system to make loans to other people and businesses. This is one reason banks exist. They connect people who have money with people who need money. Deposits, loans, payments, and trust all move through the bank like traffic in a busy city. So how does a bank make money? One big way is interest. Imagine the bank pays a depositor a small amount of interest for keeping money in the bank. Then, the bank gives a loan to a borrower and charges a higher interest rate. The difference helps the bank pay workers, run branches, cover risk, and earn profit. For example, if someone borrows money to buy a car, they do not just return the same amount later. They return the original amount plus extra interest. That extra part is the price of borrowing. To the borrower, interest can feel annoying. To the bank, interest is a major business model. To the confused stickman, it looks like money went to the gym and came back bigger. Here comes the weird part. When a bank approves a loan, it usually does not hand over a dusty bag of old bills from the vault. Instead, it creates a deposit in the borrower's account. In simple words, new bank money appears as a number. The borrower can spend it. The seller who receives it may deposit it in another bank. Then that money moves through the economy. This is why people say banks create money through lending. But it is not unlimited magic. Banks must follow rules. They need capital, reserves, responsible lending, and confidence that loans will be repaid. When loans are repaid, that bank-created money can shrink again. So money can appear and disappear through credit. If normal banks are important, the central bank is like the bank for banks. It does not usually help you buy a sandwich. It helps manage the whole money system. Central banks can influence interest rates, support banks, control reserves, and help keep the economy stable. When prices rise too fast, the central bank may try to slow things down. When the economy is too weak, it may try to make borrowing easier. This is not like a superhero pressing one perfect button. It is more like a careful driver controlling a giant money bus on a bumpy road. Too fast can be dangerous. Too slow can also be painful. The goal is balance. Now comes the dangerous question. Why not just print unlimited money and make everyone rich? Because money only works when it matches real goods and services. If the amount of money grows much faster than the amount of things people can buy, prices can rise. That is inflation. Imagine there are 10 bananas and $10. Then suddenly there are $1,000, but still only 10 bananas. Everyone has more money, but the bananas did not multiply. So people may offer more money for the same bananas, and the price rises. Printing money can sometimes help in emergencies, but too much money chasing too few goods can make life more expensive. The money printer is not a cheat code. Money is useful because it moves. A person gets paid, buys food, pays rent, saves some money, and maybe takes a loan. A business borrows money to buy tools, hires workers, sells products, and pays wages. Then workers spend money again. This movement is called circulation. Banks help this movement by storing money, processing payments, giving loans, and managing accounts. Banks also earn money from fees, cards, services, and investments, not just interest. But the heart of the system is trust. People trust banks to handle accounts. Banks trust borrowers to repay loans. Businesses trust customers to pay. When trust breaks, the system becomes shaky. When trust works, money can help the economy move. So, where does money come from? The answer has three parts. Physical cash comes from official money systems connected to the government and central bank. Digital money lives in bank accounts. And a lot of modern money is created when banks make loans, because a new deposit appears in the borrower's account. But none of this works without rules and trust. Banks cannot create money safely without limits. Central banks help guide the system. Borrowers must repay loans. People must trust that money will be accepted. So money does not come from one magical machine. It comes from a system. Government money, bank money, credit, rules, and trust. And that means every time you buy a banana, you are using a tiny piece of a giant financial machine.